What's ahead for our economy? Well, last week the Reserve Bank gave three scenarios. Interestingly, they all look good, and that could suggest we're going to be leading up to a booming economy and property market into the election next year. So in today's Property Insider video, Dr. Andrew Wilson and I unpack those, as well as discussing what's happening in our rental markets, and there are some interesting figures there, as well as to what's happening in our property markets. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. What's ahead for our economy now that we're moving into a more COVID normal world? Well, last week in its quarterly statement on monetary policy, the Reserve Bank of Australia gave its usual three scenarios. If the upside scenario was achieved, Australia would experience a booming economy off the back of strong property markets, surging household spending, a sustained global recovery, and maintained suppression of COVID. If that occurred, the Reserve Bank suggested that unemployment could even be as low as 3.25% this time next year. Now, the more likely central scenario for the Reserve Bank still has our economy roaring as borders reopen to tourists, to workers, to students, and this would lead to a strong economic recovery and a decline in the jobless rate to maybe about 4% in the middle of next year. But even the Reserve Bank's downside scenario, which could occur based on bad health outcomes or lingering uncertainty in our economy, even its downside scenario actually still looked pretty good. Now, of course, this has got the market commentators again speculating about interest rates, and not surprisingly, some are even suggesting property values could fall if interest rates rise. They're suggesting a market crash again. So, is a rate rise on the cards? What would this do to our property markets at a time when affordability is already starting to be stretched? What's happening to our rental markets? These are some of the questions I'm going to be asking Dr. Andrew Wilson, Chief Economist of My Housing Market and Australia's leading housing economist, in this week's Property Insider Chat. Hi, Andrew.
Yes, good day, Michael. We continue to evolve in these interesting times, don't we? And your comment on the Reserve Bank's scenarios, I suppose it's one of those situations where the more scenarios you create, the more likely you'll get it right.
One's got to be right, doesn't it?
Well, let's hope 1 out of 3 ain't bad, but maybe you need some more scenarios. But I actually think all of those scenarios are pretty optimistic, to be quite honest, but we'll see what happens. Not sure where all that booming growth is going to come from. We typically boom through the export sector. We've been doing quite well through the export sector, iron ore, etc. But I'm not sure we'll get the sort of levels of boom time activity we've had in previous mining booms to drive the sort of growth the RBA is predicting.
Well, the RBA is predicting, I guess, a boom time economy coming into what's going to be an election. March, maybe May next year. It's suggested with 80% of Australians over 16 now fully vaccinated and restrictions on activity easing, Andrew, our economy should recover. And of course, that's got that speculation about interest rate rises again. I know we keep talking about it, but what are your feelings now that the RBA has come out with this?
Well, we had the decision last week, of course, Michael, interest rates on hold. That was the safest bet that you'll ever have, given it was Cup week as well last week. We didn't continue what was a very old tradition of cutting or raising interest rates on Melbourne Cup Day. We left them on hold yet again. But there was some changes in the commentary from the Reserve Bank on Cup Day through their interest rate decision. And they no longer projected that they believed the next interest rate increase would be in 2024. They said basically the same thing. They said they didn't think that the underlying inflation would consistently be in that 2 to 3% band until the latter part of 2023. And they said then at that stage, they thought it would only be at the lower part of the band by that late 2023 period. Of course, that's saying the same thing, is it not? That they don't think that interest rates would be increasing until 2024. But perhaps they blinked to some extent. And you can understand that 2024 target that everybody's been referring to became a little bit of a millstone around their neck, as they've also retreated to some degree from that quantitative easing target of pushing yields down to a particular level. The market took them on there and they decided not to continue to play that game with markets. And of course, that's because they felt that with an improving economy, the need for the strength of quantitative easing that undertaken over recent months wasn't there anymore. So that's fair enough and quite understandable. But I guess the end game out of all this chat we've had through the prospect of higher interest rates and some of the hysterical predictions that early next year, we would have interest rate increases, I think just subsided a little bit, and the banks would have been pretty happy because guess what? No surprise. The banks all lifted their fixed term interest rates at the end of last week. And maybe that was the main game, Michael, because they certainly got that one through the system. But in terms of an official rise in interest rates, nothing's changed. We discussed the inflation data. Certainly one-off factors pushed up inflation. 3/4 of the increase in that underlying CPI came from higher building costs as a result of home builder and higher fuel costs, which has got a number of reasons why global oil prices are higher, and all of them have to do with COVID lockdown environment. So that'll work its way through the system. But as we keep discussing, Michael, and the Reserve Bank reiterated in its statement that incomes are the main game, that's a real concern. It's been a concern for the best part of a decade, Michael, that low incomes growth hasn't responded to lower interest rates. And we'll get the latest wage index data out within the next week, and that'll certainly tell a story, but it will be a backward-looking story, September quarter. But I think the chances are that we'll actually see real wages falling, given that spike in inflation over the September quarter. We may actually get a negative real wage outcome, which would be quite sobering because it meant basically that you're losing money as a consumer with prices rising faster than wages. And that'll, I think, stop the dogs barking for a while. But that's the main game here. The Reserve Bank acknowledges it. We've got to get wages up. And of course, with the booming economy, that's one half of the equation that will help perhaps to increase wages. It didn't last time we had a strong economy. Well, it certainly hasn't lifted wages through a reasonable economic performance over the last decade. But the offset to that, of course, Michael, is migration. And if we do get strong migration returning to Australia, and there's obviously a lot of pressure from particular business groups to resume inflation, that will, of course, increase the supply of labour, and that will put downward pressure on income. So we've got a real journey ahead of us until we certainly get to the position where we've got higher incomes that is fueling higher prices, and therefore the Reserve Bank would step in higher rates. And I think it's at least 2024, but that's a long time in the future, Michael. So we wait and see what happens because things can change, as we well know.
Well, while we know the unemployment rate's low, new jobs on seek rose 10.2% in October, and that's after a rise in September. Again, that's not really surprising, Andrew, with New South Wales, Victoria and ACT now out of their lockdowns.
Yeah, look, it's the bounce back, Michael, and we expect that. We'll get our unemployment numbers out for October this week from the ABS. Of course, unemployment remained quite low at 4.6% over September, but the reason there was because a lot of people just abandoned the workforce. So the participation rate fell, particularly in New South Wales. And that meant that the pool of labour that we measure our unemployment numbers against, the labour force, actually shrunk. So therefore, that kept unemployment low. So the question is, over October, when lockdown is now behind us, that whether we get a balance between those returning to the workforce, finding jobs, and those that are interested in participating in the workforce. So it'll be a balance between the two, the increase in the participation rate and the increase in employment. And we're likely to see a sharper bounce back this time compared to last time. So unemployment should remain maybe around about where it is at the moment, balancing out between an increase in the workforce and an increase in employment.
Now, we know property markets are slowing down a little bit related to affordability issues and maybe a bit of a scare from APRA, but housing loan approvals also fell. The last figures for September showed they fell 1.4%. Interestingly, investor activity kept rising, didn't it? Now it's comprising about 31.7% of the market, the highest it's been for a couple of years, Andrew.
The interesting point, we've had 4 consecutive months of falling home loans. And that's home loans don't include alterations and land. And I don't think we should be including those in our market models. But we've had 4 consecutive falls. No surprise we had a fall over September, given lockdowns. Owner-occupiers and first home buyers fell. But as you said, investor numbers continued to rise. Didn't rise sharply. Of course, lockdown impeded that. But we did have a rise in investor numbers. The market share for investor lending is still below 30%, and 33% is the long-term average. So it's certainly heading towards that long-term average market share, total residential loan market share, but and on the rise, and we shouldn't be surprised at that as well. Now, we'll get a bounce back, of course, when we get the October data, because of the end of lockdown. We know we've seen listings coming in, we've seen higher sales, so that'll mean higher loans. There's a little bit of lag between the real market and lending data, but nonetheless, we will see a bounce back. But markets are generally starting to sag a little bit, Michael, as you suggested, through affordability constraints, particularly the big growing markets or the fastest price increase markets of Melbourne and Sydney, particularly Sydney. Affordability has declined in Sydney by around about 16% over the past year as incomes can't keep up with higher prices. That's just a normal adjustment process. We should welcome it. It's still a seller's market, but there's no doubt the buyers are getting a little bit more confident in their negotiation process. And this is, as I said, what we want. We can't sustain 30% prices growth as we've had in Sydney per year. It's now starting to move down under 2% per month. Will likely be around about maybe under 1% per month by the end of the year. But really annualised, that's still a double figure result, and markets will still be quite robust next year, Michael. But we've caught up. We've taken advantage of all those affordability positives that have been accrued over the last 4 or 5 years. It's now being released. We hopefully have a COVID lockdown-free horizon now, and we should celebrate, I guess, the equilibrium of our markets finally. But there's some outstanding results. When we looked at the auction clearance rate on Saturday, Michael, there was clearly showing, particularly in Sydney, an easing. The clearance rate fell to well below 80%, where it's been hovering above really for most of the year. But we had nearly 1,000 auctions in Sydney on the weekend, Michael, which is the highest November auction number 4 years and one of the highest on record. And that's the old law of supply and demand, that buyers have got more choice and there's more competition between sellers. So the clearance rate has eased. Still a good clearance rate for sellers, but as the market adjusts, and this time of the year, we always see more listings coming into the market. Sellers want to clear their properties before Christmas, and buyers have that a little bit more negotiating power at the back end of the spring selling season. Similarly in Melbourne, a little bit perhaps of a post-cup hangover in Melbourne. We'll watch that market over the next few weeks because I think there's still some upside in the Melbourne market. But these smaller markets, Michael, Adelaide, Canberra and Brisbane, again, did very well, pushing 90%. And can you believe we've got Brisbane now the top auction performer in the country? When have we ever seen that before? Brisbane #1 for auctions, and some very big numbers also were auctioned in Brisbane on the weekend. A real bonanza of auctions and a bonanza for sellers because a near 90% clearance rate and the top auction market in the country as we speak, Michael. Could you?
Yes, interesting considering Brisbane wasn't really into auctions a couple of years ago. They're embracing them well now. Just quickly back to the finance. I think we should say that even though the headline said finance figures have dropped, they really still are higher than they were at pre-pandemic levels, which means people are still out there getting finance, and that's a good leading indicator moving forward.
Absolutely, Michael, and that's the point we continue to make. This is an adjustment process coming from an extraordinary high, in fact, record high levels of lending. And it's just about affordability, that because we are in this low income environment, interest rates also aren't falling, of course. Buyers just can't keep bidding up property because the bank's not going to give them any more money, and therefore they get squeezed out. And that's the adjustment process. And our regulators should have confidence, as long as bank lending conditions remain rigid. Our regulators should have confidence that the market will self-adjust. It's self-adjusting now, Michael, even though we're not going to see the cracks in the market that we usually get at the end of a cycle through higher interest rates. We'll see a much better result, which is an easing in growth. And also, we've had a lot of demand that's been satisfied, Michael. People don't buy a house every week. We've seen a lot of transactions, of course. People are going to sit back now and enjoy their properties for the next 6 years or whatever. And that's just the normal process of extinguishing demand in an orderly fashion. And we're seeing that within the control factor of our lending environment. And that's what makes Australia's housing markets over the medium to long term so robust and reliable. There's a policy statement for you.
Well, another area that's slowing down, again, readjusting, is the big fall in building approvals. But yes, Andrew, while the headlines blared, building approvals plummeted, they're still up 12.8% on a year ago. And of course they have. We've lost the stimulus of home builder and all those other incentives.
Yeah, but again, we've got to realise that was through lockdown, Michael. We had big building capital Melbourne was in severe lockdown. They closed their building industry. So obviously there were impediments through the lockdown environment in both New South Wales and Victoria. Numbers, as you said, are still higher than where they were a year ago. We have lost the drive of home builder. But I think there were some very interesting insights when we look a bit closer at the data, Michael. We saw all capitals fell in terms of building approvals over September, but New South Wales increased, or Sydney actually increased. So it was the standing result. And when we look even closer at the data, we can see the increases come through apartment development. There was actually another surge in apartment development in the Sydney market. And that's really starting to pick up now, coming from very almost historically low levels in real terms. But it's now starting to pick up, Michael. So unit development is back in town in the Sydney market. And it really was the reason building approval levels held up in New South Wales and Sydney.
We talk a lot about property prices, but the rental markets are an also important part of our property markets. And a chronic rental shortage is emerging.
Yes, Michael. And of course, that was revealed. We've been discussing this for a while, of course. We've known that there's low vacancy rates and rising rents and a real sense of a shortage of rental properties. But the CPI revealed that also. The Reserve Bank acknowledged it, that yes, they finally realised that we do have issues around the availability of rental stock and rents rising. That was part of the CPI process, was higher rents. But the CPI measures not just asking rents, but they also measure existing rents. And that's a different process in a way, because existing rents are not as marketing sensitive. That's people who aren't looking for a new rental, those an existing rental. So they're measured together. But even with that, we saw an increase in rents. But the latest, My Housing Market's latest data for the rental markets sees a continuing trend of lower vacancy rates for units everywhere except Melbourne and Sydney. But we've seen the higher vacancy rates that have really been a product of the inner city markets, the CBD in Melbourne units, which we've discussed, and the inner suburban area in Sydney. We're now starting to see those vacancy rates tighten, Michael. They're still high, but they're certainly coming down now. And of course, that's part of the adjustment process for people looking now for units, who are being forced to look for units to rent, that they can't secure houses. And also, of course, more first home buyers who are leaving the market because of higher prices. And you can imagine when we do get migration resuming and we get our borders open with those business travellers and tourists moving into Airbnb accommodation, we're going to see I believe, a sharp reversal in vacancy rates in those inner city unit markets in Melbourne and Sydney. Elsewhere, Michael, it's just tough out there for tenants if you're looking for a house particularly. A number of the capitals are now, not only are their vacancy rates very low for houses and quite low for units, but we're seeing double-figure increases in rents. And of course, there's no restriction on what a landlord can demand as a rental on a property, particularly if there's plenty of competition for his or her rental property. And we're seeing, as I said, strong rental growth now. And that's likely to obviously continue with our economy hopefully moving back into a normal position in terms of demand, but also into international demand coming in, particularly from the student market in Melbourne. So not a good outlook for tenants, Michael, unfortunately. I can't see any real change in the upward trajectory of rents and the downward trajectory of vacancy rates. And there's just no hope, of course, of matching supply at the levels that we need it to be able to offset those higher rents.
Of course, if APRA has its way and slows down investor lending, the situation's only going to get worse, Andrew.
Well, I think a lot that we're experiencing now is because of those APRA actions 5 and 6 years ago that did take investors out of the market, that did crunch the apartment development market. And I think we're paying the price now for having fewer investment properties in the marketplace. And it's not the investors that are paying the price, it's the poor old tenants who really are least capable of doing that.
And unfortunately, they're also the people whose wages aren't growing, are they?
Absolutely. And it does create social issues going forward. We don't want to end up like particularly some areas of the United States with people living on the footpath.
Well, lots of news coming up over the next couple of weeks. So look forward to catching up with you each week and getting your market commentary.
Thanks, Michael.